Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. We are recording live from Money 2020 in Amsterdam, and then we'll also put this podcast up so you can listen to it after. I'm so lucky today to have with me Teana Baker-Taylor, who is a key figure in the European crypto and fintech community. She's the Vice President of Policy and Regulatory Strategy in EMEA for Circle and has had an illustrious career across some of the key players in the industry. We're going to talk about Web3 commerce, the value and importance of the dollar, the metaverse, and all other things fintech. Teana, welcome to the conversation.
Oh, thanks, Lex, for having me. But I think you need to tell everybody who you are.
I've never been put on the spot like that. Who am I? What an existential question. I am the chief economist at Consensus, which is a leading blockchain software company that supports Ethereum and a number of other Web3 blockchain computational networks. And I'm also the founder and editor of the Fintech Blueprint, which is a newsletter covering fintech, Web3, artificial intelligence, and all the other ways that financial services are being broken by technology.
Very humble introduction of yourself. You have an equally illustrious career, so it's super excited to be with you today.
Fantastic. I've spent a lot of time collecting gold stars, and finally liberated into a podcast. Dreams can come true, children. It's possible. Okay. So maybe just to lay the groundwork a little bit about your experience before we dive into the topics. You have a background that combines operating experience at crypto exchanges, regulatory and policy experience in industry bodies representing blockchain interests and innovation interests, and then experience in traditional financial services. Can you tell us how those came together? Like, what's the thread that pulled you in this direction out of finance and into innovation and into what is still a bit of a frontier space?
Sure. So I spent most of my career in banking, predominantly transaction banking. So, the payments side, treasury side of what happens either within a bank or the services that are provided to corporates. And within that process was learning a lot about blockchain technology, predominantly for things like supply chain finance and these closed loop networks. And at the same time, learning about the technology and the open source possibilities and opportunities that the technology offered. And kind of once I went down that rabbit hole and really understood the power of decentralized finance and the opportunities that open source architecture offered outside of these closed loop networks, I was just kind of lost to it. I went down that rabbit hole. I didn't understand why we were trying to do these closed loop systems anymore. It didn't seem like we were solving any new problems. We were just kind of replacing the same with the same. And I had been working on a bunch of side projects or kind of passion projects focused on financial inclusion, and not just kind of in emerging markets, but really how do people learn how to use digital tools? How do we bring more women into, finance so that they feel confident making decisions? How do we educate next-gen youth around, sovereignty of wealth creation? So more broader than just kind of helping people that have been excluded from the system gain access to the system, which is equally important. And so, kind of once I had that moment, to me, it just seemed like I had to be part of this evolution of the way we transfer value. And for me, that value could be data, that value could be money, that value could be, identity. There's a lot of things that we can potentially, quote, tokenize and move around and secure in a way that we weren't able to do before.
One of the things that is easy to happen to you in finance is to get so abstract that you have no idea what's going on anymore. You're just at some bank driving deposits or twiddling around an interest rate because the other banks are increasing their interest rates, so how can you do it, in what geography, and so on. But it sounds like transaction banking and supply chain, that sounds pretty grounded in economic activity. Can you open that up a little bit? And I'm especially interested in sort of the real purpose of banks, like the purpose of banks and the feeling of actually contributing to economic growth versus playing a money game.
Yeah, that's a great question. I recently had a chat with the Banker magazine, and they were asking a very similar question, like, are banks going to go away? What is the purpose of banks? And I think there's a lot of discussion around kind of the fractional banking system that we have today when we are looking at kind of decentralized finance in the round. But ultimately, let me be very clear, not one of those people that thinks, short the banks, down with the banks. Banks don't provide a service, because they absolutely do.
The U.S. government will do that for us. You don't need to short the banks.
Yes, I mean, banks traditionally have been there to create credit, and we need, institutions to create credit to be able to offer credit. There's a reason why you can buy a house and, not pay for the whole thing straight away, right? There's a reason you can raise capital to start a new business. We need banks to facilitate that capital creation. And within that, then, there is that, ecosystem of a supply chain. And we don't really think about that often, but everything that we have, this little jar of honey that's sitting in front of me, or this iPhone, starts somewhere else in component parts, and those component parts come together. And then, products are created and shipped around the world. I'm simplifying this greatly, right? But along the way, there is, credit and reconciliation, and credit and reconciliation, credit and reconciliation. And so, large transaction banks manage that. And unfortunately today, this is a area that's ripe for efficiency, to really make that process more transparent, faster, and essentially digitized so that it can plug into other types of, digital reporting, for example. And that could be for tax purposes, or that could be for, planning purposes around, refilling stock, at a retail outlet, for example. But most supply chain finance is still on paper. You need wet ink signatures. And we talked about this actually like a year ago around the whole DocuSign thing, that there was a point in time where nobody wanted to use DocuSign because it just felt fake, right? And, was that string of letters at the top of the page, was that digital signature enough for this digital contract to be real? And we still have this problem, actually, in supply chain finance, where there's a lot of wet ink still going on. So that is one area that I think that we could rapidly increase the economic efficiency of the way supply chains work. And ultimately, that means that you should have, cost savings, or at least a better idea of what this iPhone went through to get here. And I think that's going to be really important when we look at things like, COP reporting, ESG, green investing. There's a lot of people that want a lot more information around the companies that they're getting involved in. And so it's going to be really difficult to report on all of that stuff if we're still dealing with wet ink and paper.
I think that's a set of really important points. And I don't know if I'm just getting weirder the more time I spent in crypto, which is probably true. Finance to me seems so secondary. It's a derivative of the thing that actually is, which is people making things. So the components of the iPhone.
Well, hopefully it should be.
It should be, exactly, which we'll get to the second part of your career. The components of the phone, or the desire to buy a house, that's the demand. And finance is there to support the demand and intermediate for people their consumption preferences, or for businesses. I want to come back to that in a discussion of Circle and USDC. But before we get to Circle and USDC, what about the crypto exchanges? And I think this is a criticism or a framing that a lot of people have for Web3, and especially for people who don't want to kind of go deep enough and engage with the function and the philosophy of it. And that is that the largest use case of digital assets is to trade them around. And that there is this sort of existential disconnect between productivity and the financial instruments in the space. And I think we can't get to the next stage of the space until those things are reconnected. But maybe if you could open up your experience in the leadership roles that you had at Crypto.com and other exchanges, whether that's a fair categorization, unfair categorization, kind of how do you think about that digital asset space?
Yeah, I think it is a fair categorization, or it was, and I actually don't think that's a bad thing. So when you look at any new technology, there has to be a speculative period. That's how you get interest. That's how, people start to play with the technology and learn and understand about it. That's where FOMO is created. And if you look at kind of the Gartner hype cycle, like all new technology goes through that speculative phase. I'm going to date myself and age myself, but I went through the dot-com boom and worked on a number of IPOs, some of them kind of famous ones that you would laugh at, but that was all speculation. Now, what happened was a number of those projects or companies did really well, and loads and loads of them did not, right? And so this is a similar type of cycle, right? The major difference is the people that were kind of playing with these companies were VCs and were accredited investors. And today, that market is open to retail investors. And I think that's kind of where people get a little nervous around, consumer protection and what is this good for? And, people are losing their shirts. And, is this a good thing? Or, is crypto just, garbage and it's just tokens moving around? So I think that the speculation phase is critical to gain attention. And then from there, we start kind of building out the infrastructure. And I think we actually saw that in the last kind of crypto winter, right? The trading numbers went down, and then out of that came a DeFi summer, right? There was all of this really cool infrastructure that took us into the next phase of, now that we know how to move these tokens around, what can we use them for? And so obviously, Ethereum is gas for the Ethereum network, and it can, facilitate transactions, and it can secure smart contracts. But what does all of that mean, right? And I think we started to see that with different staking and lending protocols and other ways to use those tokens in a financial context. From there, we're starting to see real-world application where we have companies like Visa and MasterCard and MoneyGram using tokens, essentially, assets like USDC to settle real-world transactions. So, we've seen people paying with, Bitcoin and Ethereum and other types of assets that you have to get from somewhere, right? So you're getting them from an exchange. And so the exchange becomes the marketplace, not just the venue to trade those tokens. Mm-hmm. I think that over time, we'll probably see some consolidation at the exchange level. And I think we'll also start to see other types of traditional finance offer some of those tokens that remove some of that friction of having to go to Kraken, buy some USDC, load it onto your wallet, put it onto your MetaMask, then take it on to put it into a smart contract or put it onto a crypto.com card so that you can walk into a Pret and buy a sandwich. There's still quite a lot of steps. I think we've got a lot to do to remove that friction so that the usability becomes more portable and easier to do. But I actually don't begrudge the speculation period, because I think without that, you're never going to have exponential growth.
Yeah, and I think you can talk about this capital formation phase and the exchanges as early on-ramps into the space. Like you say, there's no way to hold these assets without holding these assets. And for most people, at least up until recently, it was quite difficult to wrap around how to run their own crypto wallet and be non-custodial. And I think maybe that's changing.
I hope it's changing.
Yeah.
But I think that goes back to the financial literacy part that I spoke about in the beginning. I think it's fine to say, be your own bank. But what does that mean? And do people know how to do that? And, learning how to, I think the moment that we can go from you need to be able to secure a 12 or 24 word seed phrase to secure this wallet that you physically can't lose if you've got a hard wallet, and to, ensure that you're not scammed or phished in some, there's a lot of it's not crypto scams. It's just, opportunistic people scamming people. That kind of knowledge gap puts people at risk, right? And then, we have a whole bunch of bad press around that these tools are difficult to use. Yep. I would love to see some of that abstraction removed, because otherwise I think it's kind of not a great idea for people to be their own bank if they don't know how to do that.
Yeah, I think there can be a lot of people right now who are maybe waking up to the space for the first time, and they're waking up to it with PayPal and Stripe as the providers. Not unnamed startup in 2014 where you have to drag a little jigsaw puzzle to either give them your email or your bank account or who knows what. So you do have quite a few large fintech players now who see the prize and who've created on-ramps. So I do think that's going to put some pressure on the exchanges. And to your point earlier, there is a weirdness of paying for something with a commodity. Trying to buy a sandwich with Apple stock is strange. And I think there's just a lot of confusion what assets are for. And so that takes me to USDC and what USDC is for. I think part of the question is also what is USD for, but we'll leave that to the side for the moment. And I guess maybe we can just talk about how USDC is manufactured. And I think the adjacent question for me is that it is both a cash equivalent, as if you have a cash sweep in a brokerage account, and a unit of account on a payment rail, i.e., the dollar on Visa. And that's kind of new and confusing too. So maybe if you can touch on how it's made, and then what are the primary uses of USDC?
Sure. So the way it's made is pretty simple, actually. So you give me $1, and I take that dollar and I put it into a segregated, safeguarded customer or reserve account. That dollar sits in that account, and then I give you a token that represents that dollar, and you can go do whatever you want with it. If at any time you want your dollar back, you bring me back the token, and I remove that dollar from that safeguarded reserve account, and I give it back to you. Now, that's how Circle reserves and maintains the stability of USDC and Eurocoin. What is different about that than what a bank does, for example, because you'll hear people talk about tokenized deposits, is that we don't hypothecate that dollar. We don't lend it. We don't stake it. We don't use it to pay our bills. We don't top it back up. It's not mixed. It's not commingled with any of our business activities. Those dollars just sit there. So you'll hear the term mint and burn. You give me $1, I mint you a token. When you come back with your token, then I remove the dollar from the bank account, I give it to you, I burn the token. So that's essentially how USDC or Eurocoin is created, how it's manufactured.
Got it. Does it earn interest, that pool of dollars?
The pool of dollars that we have sitting in our safeguarded accounts do earn interest, but most regulatory frameworks have or are intending to prevent Circle from being able to pay you interest on the token, which is a whole other strange oddity.
I feel very protected from interest by the various forces that be. Okay.
So then what that does is it allows us to tokenize the dollar, right? So we have created digital cash, tokenized cash, which means you can now take a US dollar and move it around open source technology. So USDC is native on 8 blockchains. Eurocoin is native on 2 blockchains, but it can be bridged onto others. And you can move it around into any of these blockchains. You can pay for things. You can, for example, we have a pilot undergoing right now where the Stellar Network is the wallet provider for UNHCR. They are using USDC to essentially, airdrop humanitarian aid to people displaced by the Ukraine war. They then have this USDC in a wallet provided by Stellar, and they can walk into any MoneyGram anywhere in the world and cash out in whatever currency they need and whatever amount that they need. Maybe they've got $500, they only need $100. They can still kind of move around with $400 secure on their wallet and only take out $100 in cash, or 100 euros or 100 pesos or whatever they need. And so that is a way to basically supersize the dollar or supersize the euro and change its form factor so that can be distributed in, a highly transparent, very cost-effective, and super efficient way that is just not possible in traditional banking today.
I've got a couple of more questions around the financial instrument. I want to create a distinction, first of all, between what you've described, which is everything is redeemable one-to-one, with other solutions in the stablecoin space where that's generally not how it works. So to draw the distinctions with Tether, assuming the best case, Tether is collateralized, but with a portfolio of stuff. We don't know for sure what it's collateralized with. We sort of think it's collateralized with high-quality crypto assets and then some debt and some cash. We don't know for sure, but there's a basket, there's investment risk in there. Alternately, other things that are called stablecoins are aspirationally called stablecoins because they transform the profile of an underlying commodity or currency, right?
Yeah, so gold, diamonds.
Exactly. So the underlying thing, like Ether, will wiggle around, and Maker will transform it into a stablecoin that is stable, but that's subject to liquidation because you have capital markets risk and so on. Whereas here, it's not really a stablecoin because it's just the dollar. I mean, it's called a stablecoin and it is stable,
we don't
but it's
call
just
it a
it's a cash
stablecoin.
equivalent.
We call it tokenized cash or digital currency.
Right.
Yeah, stablecoin is a terrible term. I mean, in crypto, we just kind of inherit these things. Somebody says something, and the next thing you know, we're running around saying stablecoins.
Not as bad as LSD, I'll tell you that.
Well, I would just say, not all stablecoins are created equal. And we've seen that. The result of that, I think, last year with, Terra Luna, which claimed to be a stablecoin, which I would argue is a derivative.
Yep. So let me push a little bit, though, on the USDC structure. Does the dollar that is sitting in the bank account underneath, is that being lent out by the bank?
No.
Or by the many banks that hold it?
No. Our current reserve structure is about an 80-20 structure. So 80% of Circle's reserves sit in what's called the Circle Reserve Fund. It's overseen by BlackRock. It is a fund of one, and it holds treasury bills that are the lowest or the least lengthy in duration, 30 days, 90 days, something like that. So 80% of the reserves sit in T-bills, safest asset that you can, in a BlackRock fund of one that's overseen by the SEC. So, I mean, pretty boring, pretty stable. The other 20% is held in commercial banks, which allows for the liquidity of minting and burning. That is obviously has some exposure to commercial bank risk, right? And we've seen a number of those bank collapses happen in the U.S., and Circle did have money in one of them. And that was a big story. What is the impact on a stablecoin if you have money at a bank that could potentially fail? We have been working on, from a policy perspective, working with regulators and central bankers to ensure that they really understand that is the potential risk, and that ideally we would have an account at the Fed or an account at the ECB or an account with the central bank and hold our cash reserves there. And that is not an unheard of situation. There is a European stablecoin today that is an electronic money token that is regulated, that has a central account at the Bank of Liechtenstein, I think, and that's where they hold their reserves. So I think that is the trend that we're moving toward. There's been a number of discussions about this in the U.S. with potential legislation. There's a number of bills floating around that are looking at this. When we look at MiCA, for example, I think it was ironic that MiCA officially came into force within weeks of SVB. And MiCA has a 30% requirement for cash in a commercial bank. And so you can imagine the conversations that I've had with the regulators and the legislators that have put this number, it's a hard-coded number within the legislation, to say, look, we think that this opens up a lot of commercial bank risk, and it feels a little bit like crypto is, having to protect itself from banks versus the other way around.
There's a lot more I want to go into, but we're a bit pressed for time. And so I want to land us on the last point, which is kind of what is money for, and back to this point of encouraging economic growth and kind of transitioning into productivity in Web3. And I'll use the word metaverse, although I feel like if I say it too many times, Zuckerberg will appear in a puff of smoke. So Apple just released their VR headset. The metaverse is not dead. It's just designed by Tim Cook. And I think people are increasingly exposed to digital objects separate from digital assets, right? So if a digital asset is Apple stock, the rendered iPhone or the rendered sandwich or honey or whatever it is in some digital space will be the digital object, and that becomes kind of increasingly more interactive. How do you see USDC or other monies, broadly speaking, entering these digital spaces, and are they fit for use for commerce? Like, are we going to see stablecoins as the primary means of payments in these spaces? Are these Web3 spaces even commercial? Like, how do you see all this coming together?
So I think that's evolving. And I think that, the Apple vision, whatever they're calling it, is probably one of the first applications of that type of technology that I think is actually going to bring people in, partially because it's Apple, right? Some of the early feedback that, we're hearing is that it's actually quite comfortable to wear. The experience is quite good. It doesn't make you feel sick, if you compare it to Oculus or some of the others, right? So I think that it sounds like the tech is good. I listened to Scott Galloway podcast, and he's been going on for weeks that this thing's going to be garbage. And I just saw on Twitter this morning that he was like, okay, it was wrong. It's great. So I think that if you can, again, going back to removing the friction of having the experience, then you start to build on that as a platform, right? And we have seen kind of the network effect of platforms. So if you have, today, the European Commission has been doing a bunch of events in the metaverse, and something like 9 people show up, right? Like it's not a well-visited place, right?
That sounds fewer people than there are members of the European Commission.
Yeah, it's pretty silly. And there's all of these, different kind of studies that they're doing on, the metaverse and the risks and the opportunities. But I think there will be multiple metaverses. To me, I think where this Apple lens could start to build new economic models would be transitioning kind of gamers and the gaming experience that you can now have globally. And, you're competing, people can send you pizzas, there's all of this type of kind of economic activity anyway. But if you can expand that out, and, we last year, we had a couple of conferences in Decentralized, and again, it was kind of an okay experience, but, it was not really that great. But if you imagine that the experience is so much more immersive, and you're paying for your ticket to attend, and you're, paying for access to somebody's content, and all of that is somehow kind of the friction of that is removed, then, are you going to want to take off those glasses? Just to be super pedantic, get out your credit card, figure out a way to kind of transact. Or do you want it to be, kind of Mission Impossible, Tom Cruise-like, where it's a blink, blink, tick, tick, and off you go, right? And so where is that connected to? And so I think that there will be these ways that we connect MetaMask or other types of wallets that hold this value, and then we can keep doing whatever it is that we're doing submersed in this experience.
Absolutely. Just because it's hard doesn't mean you shouldn't do it or it won't happen.
Right.
Well,
I think it definitely will happen.
Yeah, I think we are on the way, and larger forces are applying pressure to make it a reality.
And I think it's incredible that, going back to your economic, it's a net new economic activity. These will be net new economic opportunities for people to create experiences, for people to create content that doesn't exist today. So it's not a replication of what we're doing. I think it will be completely new. And so then, those are areas that spur economic growth.
Fantastic. Teana, thank you so much for coming on the podcast today. If our audience wants to learn more about you or about Circle, where should they go?
So you can follow me on Twitter at Teana Taylor, or I'm on LinkedIn, Teana Baker-Taylor, or you can find out more about Circle at circle.com.
Fantastic. Thank you so much.
Thanks. Great to see you.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.